Sam Hills here, gilt's strategist at RBC Capital Markets. Hi, Sam. Are you a Posen and Miles man, or are you a Wheel and Dale man? Of course, Wheel and Dale highlighting the risks of inflation, and Posen and Miles, as we know, last month voting for a bit more QE. So which camp would you be in, would you say?
Well, I think RBC, we identify with the strand of argument being put forward by Spencer Dale.
Yeah.
Clearly there are upside risks to inflation, and inflation is going to be, we think, closer to 3% at the end of the year rather than 2%. And I think we should be cautious about just dismissing quickly those views on the MPC, which are clearly a lot more sceptical about the need for more stimulus in May.
So because inflation might rise to 3%, which is ahead of the bank's target, we should just hold pat? Stay in wait-and-see mode, or totally rule out QE? Wouldn't it be wiser staying in wait-and-see mode?
Oh, I think staying in wait-and-see mode is the right answer.
Right.
I mean, inflation has come down. I think what we're sceptical about is whether inflation will come down from above 3% all the way to 2%. We think the gap from 3% down to 2% is going to be very difficult looking ahead at what's already baked in. But I think, Andrew Sentence's comments, we also identify with the outlook for growth is going to be very choppy. And I think that's why the wait-and-see phrase is the right one, because market participants and policymakers will be uncertain as to
But you're ruling it out basically because it will stay around 3%, even though we're in wait-and-see mode. Do you think there won't be more QE when you're putting your head on the line?
RBC's forecast is that at the May meeting, the MPC will not vote to increase asset purchase target, but we accept that it's a reasonably close call, because we know that Q4 GDP was negative 0.3%. Our forecast is that Q1 will just be 0.1% positive. So it's not really that far away. It doesn't have to be that much of a downside surprise.
The BCC says 0.3, don't they? Why are you so weak?
So far we've had, particularly in January, the industrial production data was very poor. And actually this morning at 9:30 we'll get February's data. And I think that will be something which the market grabs onto as a sign of the likely next course for QE, however small a part of the whole picture it ends up being.
Why are you grabbing onto the PMI data, the manufacturing, the construction and the services, which have all shown an acceleration?
Well, they have shown an acceleration, but I think we'd be cautious about reading too much into those, because we have seen that they've over-predicted what's actually turned out to be the case for the path of growth over the last couple of years or so. So they do show some signs of optimism, but we're more interested in the real data we're going to get at 9:30 this morning.
I mean, we've had Mervyn King talk about this zigzag pattern, haven't we, how the economy might go like this. And Andrew Sentence was basically saying we've got to get used to the new normal in a new normal environment. How do bond yields perform?
Yeah, well, I mean, I think for gilt market, over the next month, we're going to be really spending almost every day just caught between one piece of data which suggests there's going to be more QE and another piece which suggests there isn't. We're going to be caught in limbo, and it will be very hard to sort of get some direction whilst we're not sure, because, let's be honest, if Q1 GDP does turn out to be negative, the Bank of England are already forecasting negative Q2. Well, 3 quarters of negative growth in a row surely would make the bond market think there's going to be more QE, and that would be good for yields.
But you are suggesting, when you're saying it, not suggesting it, you're saying the yield on the 10-year could reach 2.4% by the end of the first quarter, Sam, and 2.6%. Q2, excuse me, Q2, and Q4 2.6%. We're at 2.2% today, so just steadily creeping upwards.
I mean, I think if you sort of I know it's almost impossible to do this, but if you sort of say, well, let's say we've got to May and the bank haven't voted for more QE and things have been a little steadier, maybe Q1 GDP was all right, then I think, bond yields at 2.2 are really only 20 basis points from their all-time low, when we were really concerned that there might be an incredibly nasty outcome in the Eurozone. So I think there's more unwind of the risk aversion to come, which ought to be negative for
Is that
gilts.
incredible nasty outcome in the Eurozone, Sam, maybe not quite on the table, but in light of yesterday's Spanish bond auction, in light of the fact that 10-year yields are now at their highest level since December, before the first 3-year lending programme by the ECB on December the 21st, are we getting jittery again? Should bond investors get jittery again?
Yeah, I mean, it's going to be a long and winding road. There's no doubt about that, and there are many risks. And I think on the periphery debt, we've taken a much more constructive tone on peripheral debt in light of the LTROs, but we acknowledge it's not going to be a one-way journey, and certainly in the short term it looks like the tactical positioning favours a risk-off move, and that could run further. But I certainly don't. What we're certainly not expecting is that peripheral bond yields will get out to the wides that they were at. But back way before the LTRO. So I think that the LTRO evolution and the developments with Greece and the risks, containment of risk to the capital market in the short term, mean that we're in a lower range for yields and spreads in the periphery. But that doesn't mean to say that we won't have short-term bouts of concern like we're having now. And is the Spanish budget going at the right pace? What's going to be the reaction of German policymakers to their contribution to getting the economy going again? All of these risks will come from time to time.
Sam, thanks for joining us today. Sam Hilder, gilt strategist at RBC Capital